And my question focuses on the CFPB's proposed new regulations for next year on kind of the Fair Debt Collection Practices Act, but it seems they're also putting UDAP authority in there as well. So for related finance companies, what do you think we should be most concerned about with those proposed regulations?
The CFPB's proposed regulations on debt collection. Well, the initial regulations were proposed by the Obama administration, and the Trump administration has kind of peeled back on some of the more onerous provisions. From what I understand, those regulations aren't going to be finalized for a while. They are also looking at publishing a regulation on what an abusive practice is. And that'll be good because then you'll know. Right now, all you know is that if you take advantage of a customer's lack of understanding of a product, that's a violation. That could mean anything. So hopefully they'll dial back on some of the more onerous provisions of the Fair Debt Collection Practices Act proposed regulation and put something workable in place for UDAP. But I don't think that's going to happen for a little bit because I know they're working on both of them simultaneously.
Did we answer your full question? I feel like there was a second part.
No, they're right.
Okay. Good, just making
Yeah.
sure.
Also, just think about what do you want to be in front of a jury explaining to the jury saying, do we think this is okay? And there's cases out there that all sorts of really outrageous kind of conduct of, I promise this is out there, of somebody saying, we'll go dig your elderly relatives up out of the graveyard to collect on this debt if we have to. Well, you don't want to get in front of a jury and say something like that. I've had people hire repo companies, one whose name they went by was Mafia Repo, who said, we'll do anything to get your car back. Okay? Their heroes they listed were John Gotti. That's not who you want to do business with. I don't care what the regulation says. There's nothing that's going to be regulated out of that. But just think in your mind, when I'm in front of a jury, if I ever get in front of a jury, am I going to be proud to say, this is what we do, this is the way our employees act, or am I going to be kind of embarrassed to say that?
Excellent point. Thank you so much. Anybody else have a question? Head to the middle, don't be shy.
I've got a couple, so if you don't mind, I'll just take the mic off of here and sit.
Sure, as long as you don't take my job.
I won't. That's a promise. It'll be brief. My name is Jeff Higgins from Indiana. And a couple of things. I know there was a case recently in the news filed against the Mississippi Attorney General Jim Hood by the finance company ACA. Does that ring a bell with the panelists? And what it was, because you raised the issue earlier of legislation by enforcement. And what I read, I haven't seen the case, but what I read in the article was that that Attorney General Jim Hood was hiring a plaintiff's firm to go in and just, kill this finance company, find every little thing that they might have done wrong, or might have done, wrong, and how, I don't know how you define wrong, but the case is a pushback on that against the Attorney General to say, hey, you can't do this. You can't just go in and then start making up stuff and calling it wrong or calling it abusive when it's, it complies with, the written law of the land. So I just was curious if you guys had a comment on that, or how you see that case going, or how you see that, the winds of pushback. Are they going to go? I just was interested in a comment there.
I'm generally familiar with the Mississippi case, and it raises a bigger issue, which is that since 2010, attorneys general can enforce both federal and state consumer protection laws. Prior to that, they could only enforce their state consumer protection laws. And the regulator you're most likely to see come into your dealership is not the FTC or the Consumer Financial Protection Bureau, it's your state attorneys general. And if your state attorney general is a maverick or somebody who's in bed with the plaintiff's lawyers, like in Mississippi, they can make your life very difficult, because almost anything can be an unfair or deceptive practice. The language for unfair and deceptive practices are things that are likely to mislead a consumer, things that are likely to injure a consumer, very vague. And the finance company in the Mississippi case was doing some bad stuff, particularly on collections and repos, as I recall, but he really came down on them, and my understanding is that it was with the assistance of the plaintiff's bar. Same thing happened in New York. New York City has its own regulatory structure for automobile dealers, and just the other day, they came down on some dealers in New York for bad advertising, misleading consumers, front-ending, payment packing, aftermarket products. So it's going to depend on your Attorney General, and to the point that was made earlier, it's not a bad idea if you can begin a dialogue with your Attorney General to try and get on their good side, because whatever happens to the lender is going to come back to the dealer. And the Consumer Financial Protection Bureau considers lenders to be the policemen for dealers, as well as having the right to go after dealers directly. And that was an example of the Attorney General doing it, and that's the regulator you're most likely to see.
So would you encourage taking the first step to meet and greet the Attorney General's staff and get some foundation of understanding, or would you recommend no, lay low, keep your head down and don't?
No, I would encourage you to try and have a dialogue with them. Find out what they believe are the important issues. Find out what they see and don't like, and don't do that. Try to make a friend out of them, because if they know that you're making an effort to be compliant the way they want you to be compliant, chances are they'll go looking at the dealer down the street and not against you, unless you get a variety of complaints. Complaints are very important. You want to resolve all complaints that you possibly can in-house, because the way attorneys general and other regulators go after dealers is they look at complaints. And even if you have to unfairly give a result to a consumer, you're better off doing that than having the consumer go to the Attorney General or the FTC and make some kind of complaint about an unfair or deceptive practice or something you didn't do properly, because that's the kind of thing that can get you in trouble. So have an in-house resolution process where maybe a disinterested senior officer, maybe the president of the dealership, comes in, mediates with the consumer, and finds a remedy that works for him. In the long run, to do that is going to save you more money than it's going to cost, even when you have to be very generous to the consumer.
Ela, I know you handle a lot of these things in-house with your dealership.
I think I was kind of cringing with some of that. Because of the fact that, and again, because of our size, we tend to be a big target. Not so much to the Attorney General and things like that, because of our steps that we take to be proactively compliant. Our biggest issue are the consumer attorneys. And they come in, or what I call is economic extortion, where I have a customer that comes in and says, if you don't give me 4 new tires, I'm going to XYZ. I'm going to blast you on social media. I'm going to go to Better Business Bureau. I'm going to, but you name it. I'm sure everybody here has probably had an event like that. And while I do agree that, for us, we're very proactive on our customer service. We fix cars, we take them back, we help our customers, we cancel products as needed. But what we also found, though, was on the flip side is that people were starting to use that against us. They were looking at Better Business Bureau and seeing that we basically were, I don't want to say caving, but we were really trying to make our customers happy, because we'd rather them come back another 5 times than, just have that bad experience. And it was starting to go the other side. So certain things now, like with the Better Business Bureau, rather than apologizing, we say, we take your concerns very seriously. We're going to do a full investigation. And we'll get back with you. And at the same time, we're reaching out with our customer service team to talk to them. But just to give you an example, I've been dealing with one right now The woman wants more money for her car because she was upside down when she bought it. She's put 100,000 miles on her car in 2 years. Well, that devalues your car at a certain point. So, I mean, at some point, these people have to take accountability. But if your paperwork is correct, your processes are correct, you have things in writing, and you're able to establish, like, this is what we did and this is how we did it. And yes, you know, nevertheless, we still want to help you because you're our customer. That's the way that we've been handling a lot of these. I don't really have any interaction with the Attorney General. If anything, it's me saying that some of my local competitors are very deceptive, which makes it difficult for those of us that are honest and transparent in our advertising and our dealings. Because when somebody is advertising their car 10,000 less than you know you can even buy it for, it makes it very difficult. In Miami, it's a very dirty market down there. So I wish my Attorney General would come down and do a little bit of cleaning house.
The FTC actually encourages dealers to report competitive dealers who are not acting fairly or properly. You can file a complaint on a competitive dealer, and they want you to do that. They've said that.
Keep in mind, too, the Attorney General probably doesn't understand your business at all, especially if you're in a buy here, pay here business, because they've had no experience in dealing with it. So what they hear are consumer groups explaining their version of what you're doing. So what you want to be able to do is get to your Attorney General or regulator and say, no, this is what we're doing. This is how we benefit our customers. Because the story consumer groups are telling is how you're abusing and taking advantage of your customers. So if you don't counter that with your regulators, they're going to believe that. So you want to be on good terms with them and let them know you're trying to be compliant and you're trying to take care of your customers before the problem ever comes up.
You know, another thing too, I mean, because we're here at the NIADA, reach out to your local groups. Like we have the FIADA. They can be a good mouthpiece for you. So rather than maybe you as a dealer independently going to speak with the Attorney General, get with your group and say, hey, look, we'd like to have a meeting with them and represent sort of our state as a whole with these issues, because I think you might get more traction with that. I know that our organization is very active on a legislative level in our state, in the state of Florida, so that's something I would encourage you to do as well, and maybe bring that up as something you can do collectively as a group.
Great, thank you. Next question. I saw a couple hands last time.
Yes.
Right after this one, you can just head to the mic.
How are you doing? Chris Bean from Texas. What are your thoughts on credit card surcharges? I know the Supreme Court said state laws that ban those are unconstitutional, but in Texas, we still have a state law that says, you call the AG, the law's on the books, but we're not going to enforce it. Are you hearing anything from other states about what's going on across the U.S. and passing along those credit card fees to customers?
I believe the Supreme Court did not strike down the ban that the card associations have on credit card surcharging. I think they allowed it to continue as part of the industry. So what I've heard, all the credit card associations, Visa, MasterCard, Amex, forbid surcharging for credit cards. They do allow discounting for cash, and if you can tell me the difference between discounting for cash and surcharging for credit cards, you're a better person than I am. But the surcharging prohibitions are not going to go away, not until some court, and it would have to be the Supreme Court or a series of federal or state courts, make it go away in their states, because that's I was in the credit card industry for 15 years. The credit card industry is for consumers. It's not for merchants. It was built for consumers. It was ramped up with consumers, and the merchants are always the second-class citizens. You used to be absolutely liable on any customer not present transaction, no matter what. Now they've changed that a little bit, and if you get the CVC number and the billing address, you can win. But the credit card industry favors consumers every time, especially American Express, because they charge the consumers the highest fees, and they charge the merchants the highest fees. But merchants are always going to be second-class citizens when it comes to using credit cards. Be careful about taking credit cards for down payments, because the credit card industries have a chargeback procedure, which is not a legal procedure. It's a procedure where your bank is asked to charge back the proceeds, and it's decided based on idiosyncrasies, very tight timelines, no precedent, very much in the dark. And if you miss filing a document by one day, even if you're right, you will lose. So be careful taking credit cards for down payments, because you may wind up losing that money.
Yeah, we as a company policy, we don't take credit cards. In fact, we've only just started taking debit cards. We're very careful with that. And the other thing that we have too, if you take checks, we actually have a form that our customers have to sign. That's the check policy, that they're reaffirming the amount of money that's in there, and also allows us to go after them and after getting our car back if we need to. And in the state of Florida, you can actually, it's against the law to bounce checks. But we actually had a situation where we had a customer bounce a $9,000 check on us. Then, and this was before I came in-house. It was, I don't even, I remember I didn't even say that. I've only been inside the company for 4 years, but I've been around my company for 15. So I've represented the company for 15 years. So he bounced a check. They requested, he kept promising he was going to come back. Wasn't coming, and then the accounts payable sent it to the state attorney's office. So, and that, the paperwork, everything, they filled it out. And then I more or less, I think, forgot that they had sent it there. Well, he eventually paid with a cashier's check, but it took about 6 months for him to pay this back. Well, the state attorney was on its own course and ended up arresting him. And so he sued the dealership saying, well, I paid you. That should not have happened. Well, we won. It was a very long, drawn-out 3-year case. And in fact, he just made his final payment on our attorney's fees, so that was kind of exciting. But it, it's one of those things. We've actually gone away from sending it to the state attorney just for reasons like that. But we do know that with credit cards, a lot of our, especially our subprime lenders, and I don't know, obviously, if you're buy here, pay here, it's different. But part of our agreement is that we won't take that money on credit card, because in essence, it's like a loan to them for the down payment on their car. So I would just caution against that, because if you have an issue with that, or if you have a bounce check on one of those subprime deals, those cards can come back. So you want to be really careful. Like, we don't typically take checks on subprime deals. It has to be a cashier's check or something like that. So I don't know if you really need credit cards. I mean, us personally, we just, there's too much. They can charge it back. They can say no. They can stop payment. It's a headache that we just didn't want to take.
Thank you. Want to ask your question?
Mike Reed, I'm from New Jersey, and we have a retail location, 2 buy repair locations, and an RFC. And the question I have involves side notes or additional money owed during the term of the loan. So the scenario that happens to us a lot is maybe, a year down the line, a customer loses a transmission or a motor or something like this. More often than not, we're pitching in trying to help that situation. We're getting that vehicle fixed, and usually, hopefully splitting it with them, but whatever the case may be, at some point, they're owing us more money. So the question that I have, and what always seems to be somewhat gray for us, is what is the best way to handle that as far as how to structure that money being paid back? I mean, our DMS has 2 options. Option 1 is a side note. Option 2 is you could add it to the principal of the loan, and at that point you could either extend the term or you could change the payment structure. So what's your advice on the best way to handle that from a legal point of view?
Jeff, do you want to take that one first? Do you have any experience?
It was my preference. First, I think you can do it either way. I would probably do it on a side note, where you still get a security interest in the car, even with the side note, so you're fully protected there. I just have a little bit of an issue of if you're trying to go back and modify that original note, if you do something wrong, is it going to affect the whole enforceability? If you isolate it in a side note, there's a little bit more of an isolated problem there.
I'm curious, though. I have a question for you.
Yes.
So when you do that, are you selling these cars with any form of warranties, or?
The cars have a 60-day, 2,000-mile warranty when we sell it. We offer an extended warranty at, our cost. A power chain warranty, it's like $300 for 24 months, but nobody ever wants to buy it. But you can count on that once that motor goes or that van goes, they're
do you put any, and this is kind of why I'm asking, because like we sell all our cars as is, but we do a lot of after sale repairs and things like that. We've made a point to have what we call a goodwill agreement. Like we won't even touch a car until that person signed that, which keeps in place the as is. So we're not putting any kind of implied warranty of merchantability or any sort of warranties on those vehicles. Are you doing that with those repairs?
I hadn't thought about that. So you're talking about a scenario where you're then being asked.
I want to catch you so that everyone
Sorry.
can hear this.
I was just curious.
So you're talking about a scenario where you would then be on the hook to warrant the repair. Is that what you're saying?
Well, so you help pay for a new engine on that car and something goes south on that. Do you have customers come back and say, okay, well, you put that in. Your responsibility now to fix it with the warranty?
We make sure we don't do the repairs in-house. So the shops that we deal with when it comes to that type of repair, they warrant that.
Okay.
So typically that would be a 12-month, 12,000-mile warranty on that repair.
Still, it's a very good idea to get this goodwill acknowledgement form.
Yeah, I
because
definitely
you can't
agree.
inadvertently be creating a warranty from your dealership.
Right. Yeah, I
Even
get
though you
that.
have a third party doing it, you've had that work done, so
Right.
it ties you back in.
Right.
And that's what how many of you sell your cars as is? I would definitely recommend that for any sort of goodwill, any kind of aftermarket, anything that brings that car back to you, even before you have it brought to your property, make sure you have something in writing that reaffirms what your original agreements are on that vehicle. Because you will inadvertently put an implied warranty on those cars. And it can open up the exposure that you just, again, remember the lawyers like to play in the gray area. You're opening up a gray area that could be used against you. So you think you're doing, no good deed goes unpunished. That's one of those things that could come back to haunt you.
Yeah, New Jersey is an implied warranty state.
Oh, so you have them.
So,
Right.
what we do is we mirror, we have our own in-house warranty, and we mirror New Jersey's used car lemon law with that warranty. So, as far as we're concerned, from an attorney general point of view, that should protect us. But getting back to the side note, now that is typically the decision that we make, is we create a side note with that customer. But I think that we may be lacking some paperwork on that. Our system basically prints out a very, very simple form. I don't think it's very compliant with anything. So is there a place that you're aware of that I could find more paperwork that would associate with that side note?
What I would say, one is ask your local dealers association if they have those kind of forms.
Okay.
The other would be whatever DMS system you use, if they have those kind of forms. And then third, somebody like Reynolds and Reynolds.
I'm sorry, what was third?
Or a local lawyer who can design a form for you.
Yeah.
It's a fairly simple process for a local lawyer. It shouldn't cost you too much.
Okay. All right. I do have another question.
Sure.
Regarding consumer disputes. So we subscribe to eOscar, and any disputes that come through eOscar, we take care of those pretty much right away. We get a lot of them in the mail that are obviously from third parties. And my understanding of the law on that has always been that I don't have to address a consumer credit, I'm talking about credit dispute, a consumer credit dispute that comes in the mail and is obviously generated by a third party, like a
credit
credit repair
service.
company, something
Yeah.
of that nature. Okay, so am I correct that in my understanding of the law on that I don't have to address those?
You generally have to address them unless you have good cause to believe they're frivolous.
Oh, okay.
So
I'm glad I asked that question because I usually ignore those.
the better practice is to address them, but if they keep coming back from the same person, at some point they're frivolous and you don't need to respond.
Gotcha. Okay, thank you.
Great. Anybody else? Yeah, go ahead, please. I'm just going to stay here in case.
Hi, my name's John McQueen. I'm from California. On the side note thing, I believe that it's probably not a good idea to do with the adding to the principal, because now you're completely restructuring the deal and what they sign with respect to finance charging, that they're expecting that they're going to be paying and whatnot. So unless you're going to rewrite the deal that's probably not a good thing to do. The side note is probably better, and that has different consequences with respect to whether you're collecting interest on that or not. I'm not sure if there's any more comments on that, but that's what I've been told.
I think Jeff agrees. That's kind
Yeah,
of what
I
you
would
said.
agree. I would do it in a side note, and a lot of it depends on which state you're in. And California has its own set of rules for a lot of things in general. But it's always easier, I think, if you have it in a side note and kind of keep it isolated from the underlying car transaction.
Another question I have is, you have a customer who is has to turn in the vehicle, or you have to pick up the vehicle, but you're working with that customer to maybe collect payments to get the vehicle back, or you're sending out your notice of intent to dispose the vehicle, and this kind of drags on for a little bit of time. In the meantime, your DMS may choose to either continue to collect interest or not while you have possession of the vehicle, and while you're going this back and forth. And my question to you is, should you be stopping interest on that, or while this all drags on for each unique situation, you're still collecting, and what your bad debt is your bad debt when that at some later time?
I think you can agree with a customer to have a period of the contract interest being suspended while you're working it out, but you got to be very careful that you don't waive your right to continue to collect the finance charge and the principal on the agreement. If you're going to do that, I would do it again in a side note, and then I'd set your DMS up to do it, but it's dangerous because the argument can always be made that, well, you said we didn't have to pay interest for a while, and therefore my contract disclosures are all wrong. You didn't give me new contract disclosures about what my effective APR is, and it's a procedure you can do if you document it carefully, but it's inherent with risk because what you're really doing is amending the original contract. You're saying instead of my payment being $420 a month for 60 months, I'm now going to take a month off and pick it up again in month 42. And that is not what your contract says. And to amend that contract and get all the disclosures correct is a very tough thing.
In general, then, when you repossess or take possession of the vehicle again, and that account is still open for a period of time, is the recommendation or is there a law that you need to stop finance charges at that time? Because that, a lot of times, will just keep collecting until you choose to close that account or something's been done.
If you repossess a vehicle, and correct me if I'm wrong on this, if you repossess a vehicle until you sell it and end up with a deficiency judgment, and you have to follow certain procedures to do that, including giving notice to the customer, the finance charge can continue to run. But again, you've got to follow the procedures to collect a deficiency judgment and not just repossess the car and then be deemed to have taken it as a repossession in lieu of payment.
Right, I'm saying you could repossess the vehicle 1 month and then 6 months later sell the vehicle, and what's happened in that time period.
Well,
right?
you've made an effort to sell the car, you've got to use commercially reasonable efforts. But if the customer hasn't paid, the finance charge can continue to run, provided you notify them that you've repossessed the vehicle, notify them that you intend to sell it in a commercially reasonable manner. And I don't know if 6 months is a commercially reasonable manner. You're probably better off trying to have a quick sale or an auction sale for it and then be left with a deficiency judgment. I think I'd have a tough time saying that letting the interest run for 6 months before I sell the car is commercially reasonable.
Okay.
Jeff and Eola shaking their heads yes. Do you guys have experience?
I just say, when you repo it, you've got two choices, at least in Alabama, and it's true in most states. You can either take the vehicle in full satisfaction of the debt, in which case you don't worry about interest because you're taking it in full satisfaction of the debt. The other, what Randy was talking about, you've got to go out and sell it, and I would not let it sit around 6 months. You need to do it in a commercially reasonable manner. So certainly I would say within 30 days, you ought to have sold that car by then. If you're doing that, then interest continues to accrue. Even once you sell the car and apply the proceeds to a deficiency, interest still accrues on whatever the deficiency is. It never stops until it's paid.
Yeah.
Great, thank you. Go ahead to the microphone.
This is Bill Moker again. I think, actually, I think Jeff might be able to shed some light on this. Like in the state of Texas, you actually have to go and get bids on the car. You have to get 3 bids. You can be one or more of the bidders, and you bid the car, and then that's when then you sell it. You sell it to the auction, or you sell it back to yourself. You sell it from your finance company to your sales company, but you have to have 3 bids on. And I think that's the case that.
Yeah, again, I think it just goes back to commercially reasonable effort.
Right.
And, that's a good faith effort that, it just depends based on your state. But, yeah, it's, again, you're putting out that good faith effort to make sure that car is going out there and that the debt is satisfied and it offsets that original contract. So,
What I'm getting around to is that is there, and I know that you're from different areas of the country, do we go to our state agency to try to get our compliance issues outlined so that our sales company and our related finance company are in compliance with our state regulations, or are there federal regulations that supersede those? Does that make sense?
Well, there's both. In terms of what's a commercially reasonable sale, that's pretty much going to be a state issue. Every state, like in Texas, you said you have to get 3 bidders on the car. In other states, you have to sell it within 30 days. Otherwise, you're deemed to have taken the car back in satisfaction of the debt. So that's largely a state issue. The Fair Debt Collection Practices Act, which talks about federal law on collecting debts and having to give notice and having to do a commercially reasonable sale, whatever that means, is a federal law that I believe supersedes state law. And that'll be the regulation that's issued by the CFPB next year. Things like equal credit opportunity, fair credit reporting, use of credit reports, privacy laws, safeguards laws, those things are all federal. But the kind of nuts and bolts of what's a commercially reasonable sale and how you can proceed against a customer are largely going to be state law, and many of them are governed by Article 9 of the Uniform Commercial Code as it's adopted in your state.
Jeff and Eola, have you had more success with one way versus another that you would recommend, or does it just depend on the situation?
Well, I mean, I'm different from a buy here, pay here. So, I mean, our cars are all, they go out to the lenders. The only time that we'll repo a car is if we can't get our cars are conditionally approved before they roll, so we don't really spot cars. So the only time it'll be is if for some reason the lending falls through, like they fail like their interview, or the phone things or something comes back as fraud. And we grab those cars as quickly as we can, and then we just do a notice of intent to keep collateral, just to keep it clean so we can get that car back on the lot and sell it. So it's a little bit different because it sounds like you have cars that have been on the road for like a year or more and you're having to bring them back. So I wouldn't really advise.
What I would tell dealers is think about who your customers are. Okay, if you've repossessed a car from them, what do you think the likelihood of you being able to get a judgment and collect a judgment from that customer? For most of you, it's going to be pretty small. Okay, so if you accept that as being true, then you're probably better off just to send out a notice saying we're going to accept this car in satisfaction of the debt, because you're never going to collect anything from that customer anyway. It's a little bit easier procedure, a little bit cleaner procedure that cuts off some potential liabilities you have. Now, if you're in an area or there's a particular customer you think you can collect from, you may not want to do that. But as a general rule, I try to encourage most buy here, pay here dealers, just take the car in satisfaction of the debt, write off whatever remaining debt there is, sell the car, go make some money on reselling the car. Don't worry about dealing with lawyers and compliance issues.
Thank you. 1 second. Just a second.
If I heard what you said right, you're suggesting take the car back, don't sue for a deficiency balance, resell the car. What keeps the customer from saying, hey, those proceeds are mine. The value of that car is mine. I found the best way to do it is, whether you're going to do it or not, is to send it to the auction house. If you got 200 people with their hand up in the air, rather than buy it back in yourself. I always felt that exposed. The reason I'm asking that question is inventory is always a problem, and I would love to keep the inventory after I repossess it, but I'm fearful of it.
Okay,
So the question was, how do you keep the customer from saying that when you sell it, those proceeds are theirs? Right? Good summary?
Well, yes, I had an occasion in Indiana where I instigated that process for a while. They said, hey, we're going to keep on process okay. And let's do it by book value. So I had them have 3 books. And they did the black book and one of them. But the Attorney General got involved, and the customer did. We bought it in, we resold it. Attorney General said we didn't buy it in for enough, and that the customer should get retail value out of it.
okay. Okay, so I've dealt with that exact issue. Sure. And I've dealt with that issue. You know, once again, what I said about keeping it satisfaction is kind of a general rule. I talked to a dealer before I walked in here today who does that, but when it's tax season, he wants his inventory back where he can sell it as quickly as possible. So during that time, he sends out, in Alabama, it's a 10-day notice. I mean, we're going to sell it, and you still have the possibility of efficiency because he gets it back into inventory more quickly. That's okay. If you're going to follow that sales procedure, though, at least in Alabama, probably in most states, you can't just take what book value is and say, well, this is the value of the car. You've got to either carry it to an auction where you can sell it at auction, or if you think the price at auction is not enough, you essentially sell it to your related company at whatever the high bid is or above the high bid. Or you come have people give bids to you at your dealership. And as long as you're the high bid, you take the car and you sell it at that point. But you can't take just NIADA value or some other value. Right? Believe me, for every business, there can be very good reasons why you want to do a 10-day notice as opposed to keeping it in satisfaction of debt. That's fine. I just want you to understand there's risk involved with that you can eliminate by keeping the car in satisfaction of debt.
Thank you.
Well, actually, I should probably clarify what we do too, because with our deals, the deals are not consummated. Because the deals aren't financed, we've already sent a letter of rescission to these customers that just haven't returned the car. So when we do our notice of intent to keep collateral, it's different than what your scenarios are, because we're not buy here, pay here.
Great.
My name is Larry. I'm from Maryland. My question is about arbitration agreements. We have one. We're a little nervous about it. Are there any wording that should or should not be in those agreements so that they hold up in court?
Arbitrations are great things. And they're great things because what an arbitration clause does is it eliminates a class action. That's the biggest value. To make an arbitration clause valid, it needs to be fair. It needs to be favorable in some respects to the customer. Maybe you advance the costs. Maybe the arbitration is conducted either in where the county where the dealer is located or where the consumer is located. But you need to make the procedures fair. You need to make them simple, have a single arbitrator. I think I found is much more reasonable than having 3 arbitrators. But the biggest value in an arbitration is it prevents a class action. And that has been affirmed by the United States Supreme Court on a number of occasions. Your arbitration clause has to cite the Federal Arbitration Act. This arbitration clause is governed by the Federal Arbitration Act. Those are the magic words that should be in any arbitration clause. And then you're not subject to the state laws on arbitration that may allow the arbitration clause to be dismissed.
Viola, do you want to comment?
Yeah, I think we're slightly different on that one. And in fact, in the state of Florida, there was a time frame a few years ago where case law was going in kind of a bad direction, where they were splitting up arbitration. Like if you had an arbitration agreement in your retail installment contract, but you didn't in your purchase agreement, and they were only suing on one part, they were saying that this arbitration agreement doesn't apply to all of your paperwork, which is completely opposite to how business standards have been for years. And we actually had a class action case against us for a private tag agency fee issue. And so we took it, we filed a motion to dismiss and to compel arbitration, and the plaintiff's attorney cited to all this new law. But our arbitration agreement is different than most, even though like Reynolds and things like that, and I don't know how many of you, do you rely on the standard forms that are already in your agreements? See, we have our own. I actually drafted one. It's a single page document, arbitration agreement. We actually go under the Florida Rules of Arbitration. So, but we have it with the AAA, the consumer rules. And what we've done specifically, and this is how we won against that case, not only on the court level, but on the appellate level, was that our contract said, this is part of your car buying transaction and your retail installment contract, purchase agreement, everything that you've signed today is governed by this arbitration agreement. And that if there's any other arbitration agreements in those documents, this one supersedes and it controls the transaction. So because we were different, one, we got over that, but then our court actually clarified even more about the fact that, if you've contractually agreed. The problems that I see with arbitrations is when they're buried on like the last page of one of your documents. And somebody can say, I didn't know that you had an arbitration agreement in there. So I would recommend, if you're really looking for arbitration, make it a single form, make it something that they know that they're signing and that they understand that they're signing. Makes it a lot harder for them to move away. I wrote it in a very broad term, so it's any tort, any fraud, any negligence, anything, there's like a whole laundry list, like just about anything that people can say is actually written into that, so they can't say, oh, well, that was not contemplated in that arbitration agreement. We like the arbitration agreement, not so much that it's class action, which is definitely a plus. The bigger thing for us is it really limits the amount of discovery that they can do. Because oftentimes we find when these lawyers go into court, they do like a fishing expedition to you. Like they want all of your deals and all of your paperwork and all of your this and all of your that, because they're hunting for something that they can get on you. In arbitration, it's very narrowly tailored down to the things that they need, and it's kept it much more efficient for us. So we're very protective of our arbitration agreements. And we've been pretty successful even keeping people back into the state of Florida, even though we sell throughout the country now. So it is to a benefit, but just make sure that they're visible. Make sure your customers understand. I would take the opportunity to review what your arbitration agreement says, kind of like what you were saying with the 3-panel. Part of the reason that we went to our own is we typically win our cases, and we had one where we won the case. All the claimants' claims were denied. But the way that the standard arbitration agreement was written at that time into our contract was that either party could appeal that decision and go to a 3-panel. If there was it was like the language was like if there was a 0 award. And the plaintiff's counsel tried to argue that because their claims were denied, that was considered a 0 award, and tried to go appeal it to a 3-panel, which ended up, we won that anyways. But it's just costly. If you're doing the right thing the first time and you're having to protect yourself against stuff like that, make sure that those agreements really do that for you, so you're not spending the time on your lawyers defending something that you did right the first time.
An arbitration agreement is a great idea unless you're in a single document state, like California, where you have to have everything in the document, and it should be prominent in the contract. And it's a good idea to get the customer to initial it, that clause, if it's in your contract, so they can't say they didn't see it or read it. Put it in bold print, put it in larger type, but a separate arbitration agreement is good. And
as long as it incorporates, have it read that it incorporates all the other documents that they're signing in that transaction, which is what we did. So there was no way of saying that anything could be broken away from it.
Think about when your customer's in there signing documents, what do they want to do? They want to finish, they want to go get in their new car, okay? You can put documents in great big bold letters that's real clear, real easy to understand. They don't care. They just want to sign it so they can go get in their new car. Okay, so make it clear. You're not doing anything wrong, and there's no reason to bury anything. Make it clear so somebody, if they take the time to read it, can understand it. And then let them go get in their car.
We have a couple more minutes, so we can take one more question. Go ahead, come on up to the mic.
I was just wondering if you could speak on the Sailors and Soldiers and Sailors Act and how it applies to changing interest rates for customers that are being activated in the military.
I'm sorry, did you say soldiers? And
Soldiers and Sailors Act?
The Soldiers and Sailors Act that requires you to reduce their interest rate down to 6%. I have
Correct.
a situation like that, but I have no idea how to proceed.
What state are you from?
Minnesota.
Okay.
the Soldiers and the Service Members Civil Relief Act, formerly called the Soldiers and Sailors Civil Relief Act, requires you, if somebody's called up into service, to lower the rate on their pre-existing contract to 6%. You also can't repo the car without giving them notice. And there's a couple of other protections in there as well. The larger problem statute is the Military Lending Act, which I'll spare you the details on, but in December of 2017, the Department of Defense issued an interpretation that basically said you can't sell gap or credit insurance to a Military Lending Act covered person, which is broader than a service member. And you can't do that. They're working on trying to change that. They're working on trying to let you sell gap. But your credit report should tell you if the person is an MLA covered person. If they are, don't sell them credit or gap insurance, or your security interest in the vehicle will be voided. The soldiers and sailors, you have to reduce it while they're in the service. Once they're out, you can go back up to the old rate. And you have, if you're going to repossess the vehicle, you have to send notice. Those are the principal protections. There's others as well.
Yeah, just so you're aware, before you go repo a car, there's a website you can check to see if somebody's on active duty. And you need to be checking that website and documenting you've done that before you go out and do something. Because it's not just civil penalties. There's actually a dealer in Alabama criminally convicted in federal court for intentionally going out and repossessing a vehicle from someone who's in active military. You don't want that published in your hometown paper, okay? It's bad publicity, believe me.
Great, thank you so much. Do you know the website?
I think on the MLA site, right?
I don't, but...
I mean, one of the things that we did with the Military Lending Act, right when it was first coming out, we're on an automotive legal group, and they had already started talking about like the day it came out. We actually have a policy in place that anytime somebody is looking to buy gap or any of that, we run them through, and it's the Military Lending Act. Like, they have a website.
Correct.
And you can put their information and their social in, and it'll tell you whether or not they're considered active, because it's not only just members of the military, it's also their dependents. And so what we've actually done as part of our policy is we have our finance managers print those out and put them in every deal if they're selling gap, so that we can show that we've tested it. Just to be sure with that. But I would just Google search like Military Lending Act and things like that, and those websites should come up. But I would make that as part of your process, so that if somebody comes to audit you on those things, that you could show them the steps that you're taking to. And again, I guess buy here, pay here is different, but a lot of the lenders won't even finance those deals if you have gap on there, and if they find out that these people are protected under that act.
You can rely on a credit report telling you a person is or is not an MLA covered person. That's a safe harbor. So your credit report should tell you that. Or ask your credit reporting company to provide that information to you.
I'm seeing a lot of military clients that are suffering because of this law being implemented, and it's the banks that are really pulling back and saying, we're not going to touch anything with that. What if I just sell it to the military member on the side cash?
Can't do that. It's considered part of the same transaction. If the Department of Defense or the Department of Justice learns that you're selling it separately, it's really part of the same, it's part of one transaction.
Because you have a finance contract which they're going after, but if I just sell the gap on the side, cash, that's a separate transaction.
Well, but it relates to the vehicle transaction. So it's the equivalent of putting it in the contract. So that doesn't work.
Randy's tried. He was trying to find a way around. Thank you so much for your participation today. You really made this a great panel. Thank you to our panelists for all your expertise. You all enjoy the rest of the show and have a great day today.